Looking to boost your financial modeling skills? Check out the programs at Financial Modeling Institute, the world's only financial modeling accreditation body. Learn more by visiting fminstitute.com today.
Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about commercial real estate. We are talking with Sean Leese. He is the Chief Investment Officer and Head of Funds Management for Nuveen's Real Estate Group. They are $100 million America's platform. He is a member of Nuveen's Global Executive Leadership Team and America's Investment Committee. Previously, he was an MD of Capital Markets at Grosvenor Fund Management, and he also worked at Morgan Stanley, Lazard, JP Morgan, and Sullivan and Cromwell. He got his BA, MBA, and JD all at Columbia. So welcome to the podcast, Sean.
Thank you, Rob. It's a pleasure to be here.
So we're at a strange point in real estate as a whole. I'm wondering how you think lending will evolve in the coming years to accommodate some of the pressures on the sector that are well known and what that will mean for investors in debt and equity.
Now, that's a pretty important question. Couple of observations. I'm going to talk about a flight to quality, and we'll also talk about some consolidation. Let me expound on that a little bit. All right, so we expect a continued flight to quality, where the largest and most financially stable bank lenders in the market will continue to rationalize their balance sheets for real estate assets, and they're really going to only provide liquidity to their top-tier financial sponsors. Right. Part of the reason those lenders, will focus on the larger sponsors is that there are multiple business lines and touch points across organizations, and they can do lending more efficiently, right? With fewer people, they can, marshal their resources. But as regulatory oversight and the implementation of the Basel III endgame come into focus, on the regional lenders, we do expect a liquidity squeeze for smaller and mid-sized banks, as well as for financial sponsors operating in the commercial real estate space, right? So there's likely going to be consolidation on both fronts there.
So let me just unpack this a little bit because there's a lot of factors in there that are, exceptionally interesting to me. One is the flight to quality. Do you think that that is a substantial portion of a lot of lenders' books, or do you think they're going to get the keys back from some of these owners?
Yeah, when I say flight to quality, what I'm referring to there is the large money center banks, right? There's generally four of them. What they're talking about is they're talking about working with far fewer borrowers, right? And what they're going to do is they're basically going to say, these are the select, say, 15 that we're going to work with. Whereas before, maybe they would be making loans to, 150, several hundred different borrowers. And at this point, what they're really doing is they're saying, we're really focusing on the top 15, and those are the ones we're going to be actually making loans to.
Right, and Basel is essentially going to help them get there.
Well, no, Basel III is going to increase the cost of lending, right? So there's going to need to be a higher capital charge. And so what's going to happen is, with Basel III, is it's going to be more expensive for banks to lend. And so we expect that among the smaller and mid-sized banks, they're going to have to consolidate in order to find efficiencies. Mm-hmm. Because of the higher costs of lending.
Okay, so let's talk about it from the investor side now. How do you think investors are going to benefit or not benefit? Do you think it raises due diligence requirements? How do you see it from the investor side?
Well, from the investor's side, I think the secret is going to be that they're going to need to focus and direct new investment flows toward managers that have a diversified platform and that maintain access to strong liquidity from lenders, right? This will be the best way to take advantage of the repricing that's taken place in the broader CRE marketplace across all asset types.
Okay. The other thing I'd like to just talk about a little bit is there are a lot of headlines appearing around office. A lot. Could you describe the situation with office right now from your portfolio or from what you think about the marketplace and where you think we're headed?
Sure, absolutely. Now, that's a really important question because I think for most investors or just people interested in real estate, they're seeing the articles that come out, right? The headlines are salacious, and they talk about CRE broadly taking down the banks and taking down the whole economy, et cetera, et cetera. And really, when you read through those, what you're going to find is that the problem assets, and there definitely are problemed office assets. What they are is they're concentrated among older vintage assets that have a high degree of obsolescence to them, right? So think of B and C class office buildings. And the reality is there's very limited demand for those kinds of properties, right? So the general demand for office among office users is decreased. But what's happening is it's all kind of gravitating over toward higher quality properties. And so you can see that in vacancy rates, for example. So if you think of properties that are 2015 or newer or have been renovated within that time frame, right? You might be looking at an overall vacancy rate that's less than 10%. On the other hand, those that are older than that, are basically hanging out at north of 20%, right? And that's a real problem. And that's creating a dynamic where you in the office space where you have the haves and the have-nots, and you have those spaces that people want to be in. And if you've got the better quality assets, people are actually willing to pay higher rents, right? I'm kind of shocked to see some of the rents that are being paid these days for the higher quality assets, right? People aren't afraid to pony up for that. But if you've got those lower quality assets, there's almost no value there. Just nobody wants to go there. And as a result, the amount of CapEx spending that's required to retrofit an older building and bring it up to speed is extremely, extremely high. And so that's why you're seeing the valuations fall in those lower quality properties. And you're seeing, a lot of keys being handed back to the lenders, right? Where the lenders are going to need to figure out, what to do with those properties.
Right, which leads me to my next question, because you've been around the industry for a while. What can the lenders do with those? Because if you look at it like this, from a balance sheet perspective, this is a perfect storm. You have really low revenues, expenses are increasing, and massive CapEx. So what can a lender do with this? I mean, most of these buildings are not convertible into residential because they're floor plates. I mean, when I say most, I mean almost all of them. If they do it, it's real expensive. So, and it doesn't really help the housing market with its problems. So what can they do?
Well, what we're seeing is it's been, during the course of 2023, I'd say there wasn't a whole lot of transactions that were happening where the distressed offices were actually sold. We're starting to see an increase in sales of non-performing loans that are backed by offices. So there are, groups taking a look and thinking about what to do with those properties. There are, banks that have taken back the properties, are just selling them. And these could be properties that were once trading for $800 a square foot, and they're selling for $150 a square foot. In a lot of cases, this is probably less than the land value, right? And why is that? Well, it's because when it gets sold to somebody at $150 a square foot, if that's less than the land value, what's going to happen is they're going to scrape the building, and they're just going to build, say, multifamily, right, on those sites, right? So if you take a place like New York City, right, which certainly has a lot of assets that fall within this category, right? It's something like only 4 or 5% of those buildings, as you were saying, are really appropriately situated to convert on a cost-efficient basis to multifamily, right? And what are the considerations? Well, plumbing. You've got to drop plumbing in weird spaces. There are certain light requirements that are necessary. So you need to have light wells that go down, right? Yeah. So that becomes a really complicated thing to do, and it's very limited. We also see conversions to things like lab space, right? So there's only, a couple of years ago, 5 years ago, there's probably only about 1 million square feet of lab space in the city. Today, there's over 2 million, right? And that's a bit of a shame because the city's got a lot of the brains here, and a lot of the capital, from the NIH is being invested here. And there should be more lab space here, right? Instead, somebody gets a great idea at NYU or Columbia or one of the great hospital systems that we've got in the city, and well, they've got to go and they've got to further develop that up in up in Boston. Or out in San Francisco or San Diego. It would be great if those people could stay here. So there are definitely lab conversions that are going on, but you still need. Not every building is going to be amenable, right? Like you're going to need to start with something like 15-foot ceiling heights. You're going to need to have floor loads that are 250 pounds per square foot, right? If you don't have that, well, the building's not appropriate,
right?
Like the bones of the building. So guess what you're doing? You're ending up scraping it again. So unfortunately, scraping is probably one of the biggest things that people are going to do with office buildings of this variety.
Yeah, it's exceptionally interesting. Well, let's take a little shift here to some of the other real estate subsectors. Do you see any standout risks or opportunities in, serve farms or anything like that?
Yeah, well, some of the areas that I think are most exciting right now are things like industrial, right? So industrial's been a darling for a long time. That wasn't always the case, right? Go back to the GFC, and industrial was one of the most maligned asset classes, right? And then really it was kind of the advent of e-commerce that created tailwinds that really drove the demand for industrial. Today we've got other dynamics that are going on that are equally as good. I mean, e-commerce is still very real, but I think what a lot of people don't appreciate is that actually the e-commerce penetration, if you look at the users of e-commerce, it's really among the younger people who have less money. And so I think there's going to be actually a continued accelerated growth of e-commerce, which then directly translates as those younger people get more and more wealthier,
Yeah.
right?
Higher
And
paying
they
jobs
start
and
buying
yeah.
more, right? Exactly, as they grow up.
Yeah.
But they're going to be, so I expect e-commerce to be one of the drivers and continue to be. But the onshoring dynamic is a very real phenomenon, right? When you look at the number of new jobs that have been made, that have been created in this country around just manufacturing, it's pretty extraordinary. And we're not just talking about things that people know about like chips, computer chips, right? Or even pharmaceuticals, right? Because we're bringing home a lot of the pharmaceutical production. But it's even things like I've looked at some of our properties, where they're making mattresses, where something that you felt like, all right, this is the type of product that probably should be made,
Right.
Abroad somewhere. Well, we're just bringing them home and doing that here.
Well, isn't a decent hurdle to that is infrastructure, is my understanding in general, because there is not sufficient roads or other types of intermodals built around all of those places. Do you see that as a short run hurdle, or are we getting there, or is it?
Well, I think what that does is, with respect to industrial specifically, is that it actually creates, like a lot of people just think, oh yeah, I can just go and build a new industrial property anywhere. It's super easy, no big deal. But the reality is NIMBYism is pretty strong,
Yes, it is.
as it relates to industrial development and permission to build new industrial. So it is relatively easy to build an industrial building, say, compared to multifamily. But the permissions are becoming increasingly harder to get. Nobody likes all of those trucks that go, impacting the highways and the roads around. But you were asking about other sectors that might be, tailwinds, headwinds, et cetera. Another sector that a lot of people have been really excited about is multifamily, right? And that's obvious, right? There's between 3.5 and 5, depending upon who you ask, 3.5 to 5.5 a shortfall of that many housing units around the country, right? So you'd say there's an incredible demand for that. Well, what's happened recently is, particularly in the Sunbelt markets, there's been a whole lot of multifamily development, right?
Yep.
So, the rents that you can charge, whether you can fill up your apartment units, is a supply and demand question, right? And the demand is definitely there. There's a lot of demand, but the supply, over the medium term has definitely outpaced the demand, which is causing, I think the market it's not going to crash, but I think it's going to take a while to absorb all of the new supply, right? So overall, the country's got about 6% of the existing stock is being delivered. That's going to take, and in certain markets, like some of the better markets, like in Nashville, that number is 14%. That's a big, big number.
Right. Well, Nashville is, we could have a whole separate podcast on Nashville because
Sure
it's been an exceptionally interesting market for real estate, but also for infrastructure. But, taking this to, the other level, are you seeing any subsectors of the overall real estate world that you think are overpriced or facing other types of headwinds that we haven't discussed so far?
Well, Rob, that's kind of the exciting thing about real estate, the real estate market right now, is that the operational side, right? Definitely offices aside, we'll put those off to the side, and that operational weakness that we're starting to see come through a little bit here on the multifamily side, right? All of the other sectors are actually doing really, really well. Retail's doing well, healthcare related real estate continues to do very well. And at the same time, though, you've had this pricing reset. So overall, you're talking something like, 20% down in values, right? So if you're trying to say like, which of these sectors do we think is overvalued at this point? It's all been reset, right? So there's a new price level for it. But given where I think I see some weakness on the multifamily side, that's a place where I'm kind of surprised to see the actual deals that are happening out there in the market, right? And there's limited universe of deals that are actually getting accomplished right now. But the multifamily deals in particular are coming in at pretty rich pricing, right? There's a relatively strong bid for multifamily assets, right? And what I mean by that is, something that before may have been a sub 4% cap rate or hovering around 4%, right? We're now seeing them at sort of 5%. But when you think about a treasury that's hanging out at what is it today? 4.5 or something like that.
4 3/4.
Feels like it should be a little bit more than that, So that's one place where I'm just a little bit trepidatious.
Okay. Yeah, I mean, this is all exceptionally interesting. One thing you mentioned also is operational efficiency, which I know, some of those price changes force that. Some of the increase in expenses is forced operational efficiency. Do you think there's a wave of operational efficiency that's going in real estate right now, or still going, or where do you think it is?
I think that's the one place that you actually can control some things, right? Is you can only do what the market allows you to do from a rent perspective,
right?
As it comes to kind of the cash flow coming off the properties. But you can certainly take a look at the expenses side, and you can try and think about how can I run this property more efficiently and reduce the expense side. Now that becomes a really challenging thing because taxes seem to be going only in one direction. That's a huge part of the expense base for operating properties, as is insurance.
Mm-hmm.
So when you've got those two things, although the insurance rises seem to be mellowing out a little bit, right? Last year was a pretty bad year for insurance increases, and this year, still above average, but much less than it was last year.
Yeah.
So I think the one thing that everybody is doing is they are definitely looking for ways to improve operational efficiency, and there's actually a lot of technology that's coming through that's really helping out to make that possible, and we're excited about investing in those technologies and implementing those across our portfolios.
Yeah, there's a massive amount of everything that, not to too deep in the weeds here, but I've seen it monitors your boiler, monitors different types of sensors within the building. It's amazing what is possible now. Well, thank you, Sean, for sharing all this. If you like what Sean had to say and you want to hear more from him, I'm pleased to say that Naveen and CFA Society New York are working together on an event in New York City on June 17th and 18th, hosted by Alts NY. Now, if you're a member of CFA Society New York, you should really consider registering, as your membership gets you a very solid discount. If you're not a member of CFA Society New York, you're sitting in the catbird seat because the discount is worth almost the cost of the membership. So if you're a non-member and you're listening, consider joining now. So thank you, Sean.
Thank you, Rob. It's been a real pleasure.
And thank you to everyone who's listening. Until next time, I'm Rob Rowan, and this has been Compound Insights.